afternoon. I'm sure many of you would like to take a nap after a lovely lunch rather than listen to the same old cliched thing. But anyway, thanks a lot, PMS Bazaar, for having me. I think it's a wonderful conference and it is gaining strength year by year. And I think it's the presence of all of you that makes it so nice. What I'll do is I'll present 20 minutes. Maybe, we'll have time for 5-7 minutes of Q&A. Very simple presentation. I don't like to do too many exotic presentation, but what I've tried to do is just pick up one small thing which might add a little bit of value. That is what we think, rather than, taking you through a very, very, very long kind of a thing. And I do believe that there have been so many illustrious speakers who have already spoken and who will speak. And I think all of you can take even one thing from each one of us speakers. It would be time worth spent. So the topic is very simple, moving away from the obvious, lessons from the recent past. I think the market is at a stage where, things are pretty much stable. There is obviously optimism from a long-term perspective. Near-term, things are pretty much there in terms of valuation, and therefore it doesn't make sense to tell you what stocks are going to be multi-baggers. I think right now the more focus should be that we don't make too many mistakes. And I think the idea here is just to highlight sometimes what is obvious gets, we all get carried away, and how we can avoid, getting sucked into it and learn from the mistakes. So just to set the tone right, I think this is a core investment philosophy, and I'm just going to take a minute on this because this will set the tone of how we have come to the conclusion that there were mistakes which were very obvious. So I think very clearly one is we like to invest. We are alpha generators. We don't allocate. And there's a difference. A lot of times when you get money, you buy the obvious names. You'll buy a Reliance Industries, an Asian Paints, an HDFC Bank, a Kotak Bank, because these are very obvious sort of benchmark names. And, the reason we have invested in them is because we feel that, you can't be too away from the benchmark. So they're very obvious. I think we don't believe in that. For us, every stock which we want to invest should be an investment, not an allocation. Second, again, we are very clear fundamental driven. I think there are a lot of stories which keep on coming in, and I'll highlight a few of them. For us, we only invest in profit-making companies because our view is that investing is becoming a partner in the business, and you would like to become a partner in a business which makes profits and where there is visible profit growth. Third, we are happy to be contrarian. Again, this is away from the obvious, and this stems from the large team and the large number of companies which we track. And I think time and again, alpha has been made in stocks which are not the run-of-the-mill, and which are something to do with, your own identification, your own hard work, and maybe you are the one, the only one or the first one to be invested in the stock. Fourth is, again, we say no to no sectors. So, there are funds who would say that we will not invest in commodities, we will not invest in this, and we will not invest in that. For us, it is very clear, as long as the stock and sector fulfills our key criteria of, fundamental, valuation, we will be willing to invest. Fifth, we are buy and hold. We don't believe in buying, selling, because the only people who make money out of that are the taxation guys because of short-term and long-term gains, the brokers because of brokerage, and the exchanges because of exchange fees. And last but not the least, the most obvious companies or the best companies are not necessarily the best stocks if they are priced to perfection. So this is the core philosophy, and I think when I go a little bit forward, you'll understand why we are trying to say this. And on the basis of this, we have created this very simple MEETS framework. We call it the MEETS, MEETS framework. M is management. Everyone knows that we need to invest in good management, but what is the definition of good management? Someone wearing a good suit, someone studied in Stanford, is that good management? So from our perspective, discipline in terms of capital allocation is the best criteria of deciding whether the management is good or not. So the minimum ROC, ROE we look at is 14 to 15%. Any stock below that, you would tend to avoid. Second is earnings. Equity is a growing asset class. We will invest in companies where profits can double ideally in 4 years, maximum of 5 years. Because if the profits double in 4 to 5 years, the value of the business, even without a P re-rating, will double in 4 to 5 years. Event trends and disruptions, we are in a disruptive world. A lot of times, and I have a slide ahead also, that it is not only about the earnings growing, it is also about the P. And P is perception. So if you look at newspapers, they're great moat, because if you are used to reading a Times of India or are used to reading an Economic Times, you'll read it all through your life. But the new generation is shifted to the digital mode. And that's why the P of newspaper stocks have contracted. The same is the case with TV channels. The same is happening on the passenger vehicle side, where the only passenger vehicle company in the world which has created significant wealth is Tesla, despite it being much smaller than the BMWs and the Mercedes of the world, which trade at 6-7 PE multiples, only 6 and 7, largely because there's a threat of disruption. So I think these event trends and disruptions have become very big and are very relevant, and one should definitely look at it, because you might go right in your assessment of future profitability, but if the PE shrinks, you will end up making losses rather than profits. T is a timing. I think this theory of mean reversion definitely works. Again, momentum sucks us all in. We get carried away when the stock price is moving up, and at some point of time, we give up. Ke chalo le lete hain ye. I think have patience. As I said earlier, the best company is not necessarily the best stock if it is priced beyond perfection. And last is the structural bit. There will be some companies, some sectors where structurally there is growth which is significantly higher. So despite our value-conscious approach, there are definitely some stocks where we will be willing to pay a higher P. So the investment philosophy and the framework is basically the Bible, the Gita, or whatever you call it. And this sets off the sort of a background of what we do when we look at companies and sectors. I think what I've tried to do here is, sometimes, as I mentioned earlier, the obvious leads us to become a little bit, I would say, more lenient towards buying stocks at crazy multiples and so on and so forth. So the first, I just want to highlight, we had 5 years back, exactly 5 years back, towards the end of 19, released a note called Bubble in Quality. And that time, if you remember, any stock which was considered to be quality used to trade at fancy valuation, and nothing other than quality was working. And as a result of which, I think we all got a little bit swayed by this, and we believe that a good company can be a good stock forever, and you can buy them forever. And these were some highlights. The companies do well, the analysts start to believe that they will continue to do well, but ultimately, the valuation has to reflect the growth in revenues, the growth in the operating profit, and the growth in the net profit vis-a-vis their valuation. And I think this was the list. So this was the list of companies which we had pointed out in the report in 2019, starting from Hindustan Lever all the way down to a few other names. And if you see, most of the companies were trading at P multiples of 60, 70, 80 times, which is fine, if they're growing at 25, 30%. But most of the companies were growing at 7%, 8%, 10%. Which was lower than the nominal GDP growth of the country. So our view that time was very clear that these are great companies. There is absolutely no doubt about it. No one can doubt whether Hindustan Lever or an Asian Paint is a great company or not. But they were not great stocks. Because if you buy something which is growing at 10% at a 70 PE multiple, to generate even 10% return going forward, that company will have to trade at a PE multiple of 70 times all its life. And it has never happened anywhere in the world. Even if you look at US, even now, there are less than 10 companies which have traded at a PE multiple of more than 50 times for more than 5 years. And that includes the life of Meta and Microsoft and Google and so on and so forth. Even NVIDIA, if it grows the way it is growing, will be a 20 PE stock very soon. So I think the genesis is that, yes, quality is good, but at what price? And I think what happened after that? So if you see, this is the absolute returns. So out of the 25 odd companies, 20 companies have significantly underperformed even Nifty. And mind you, last 5 years, anyone could have beaten Nifty. In fact, the broader indices are 200%, 300% return. And these companies, despite phenomenal brand equity have given nothing. In fact, there are some companies, if you see Kansai Nerolac, Bata, Whirlpool, which on a 5-year basis have given you negative returns. So if you invested 100 5 years back with Kansai, you would have been down to 75. Whereas any other fund, one of our funds is a 5x in the last 5 years. That 100 would have become 500, but here the 100 has become 75. The bottom 4 or 5 companies have done very well compared to the top 21, and largely because those companies got their mojo back and they've been growing upwards of 25% for the last 4 or 5 years. And those are predominantly the capital good companies. So I think the bottom line which we are trying to showcase here, that even 5 years back, there was this huge, obvious sort of move towards buying anything which was quality at any price. But it doesn't work, because equity is all about becoming a partner in the business, and you will want to become a partner in a business where what you pay today will be more than repaid back to you by way of future profitability. And I think these are really, really very clear. The other thing which we try to do is comparative, that many times, we say that ये तो चलेगा ही नहीं, इसमें कुछ होगा ही नहीं, ये commodity है, ये है, वो है. But it was again very clear. So we took the 2 companies, Hindustan Lever and Nestle. See this, Hindustan Lever and Nestle in 2019 put together, they had a market cap of 6 lakh crores. And they used to make a cumulative profit of 7,600 crores. Against that, the entire construction material, steel, metal, mining, all put together had a market cap of 6 lakh crores with a profit of 46,000 crores. So you could sell Hindustan Lever and Nestle and buy the entire steel capacity, entire metal capacity, entire cement capacity, entire building material capacity. Now if India has to grow, खाली साबुन तेल बिक के तो इंडिया नहीं ग्रो होगा. You will need steel and you need everything. So it was so obvious. And if you would have just done the reverse, see what would have happened. The market cap of 6 lakh crores became 16 lakh, 17 lakh crores. And Hindustan Lever and Nestle put together, absolute basis in 5 years have given only 50% return. And the profit, this 7,000 has become 14,000, the other 65,000 has become 112. So profit growth is similar, but the market cap growth has been phenomenal, largely because it was such a undervalued segment. I think the idea of just giving you the simple examples is you don't have to be a rocket science. Sometimes very, very simple things in the market can lead to significant variation in the returns. And it was, it's so startling, like you could buy the entire steel, entire cement, entire aluminum, copper, mining, Coal India, everything put together for the price of one Hindustan Lever and one Nestle. This is, as I mentioned earlier, very important. What is the market price of a stock? Market price is equal to EPS into PE. EPS is the earnings. PE is the perception. Many times, perception goes through the roof, and that is where, you end up having significantly overpriced stocks. And many times, the perception goes really, really low, and which is when you get an advantage of buying very, very value-oriented or cheap stocks. And I think as earnings become consistent, the perception also improves. So I think what you have to look at is where earnings as well as perception both can improve. If the perception is already high, where the perception cannot go further high, then the only returns you will make is by way of earning. And in fact, the perception can fall the other way around. But stocks where the perception is also low and where the earnings can also rise, I think that is where you end up making multi-bagger returns. Now, what are the recent themes? It's a very simple presentation, nothing this thing. So one is, always there are themes. There are always, I call them, the buzzwords. Right now the buzzword is EV, solar, EMS. A few months back, the buzzwords were something else. And I think these buzzwords lead to significant overvaluation, much ahead than the fair value. And I think what happens is typically you compare one versus the other. So, if you want to sell a story in one stock, आप बोलोगे अरे वो देखो 70 PE में है, ये 60 PE में मिल रहा है. तो 60p वाला 70 नहीं होगा और 70 वाला 60 हो जाएगा. And I think we have seen that many times. So what are these? So buzzword railways. So railways is a buzzword, great potential, but see the valuation of a lot of these stocks. You know, nothing is value, and this 35 and 37 are also finance companies, which normally don't trade at these companies. In fact, IRFC will trade at a multiple which is significantly higher than even HDFC Bank. And what typically happens, it is not that the companies are bad or the sector is bad, but because everyone gets sucked into it, on the slightest correction, the price fall is very significant. You know, so good theme, good potential from a 4-5 years perspective, but at what valuation? And I would say that some of these companies will do well even in the market, but not all. So as an investor, one has to be careful that just because a theme is doing well, you don't get into any stock without looking at the fundamentals. The same thing has happened in defense. Again, you know, great theme, but see the valuation. 160p, 160p, 95p, 80p, 92p. And as I said, some of them will do well, but when the correction happens, see the kind of fall which you end up witnessing. IPOs, again, very buzzword, lot of interest. Any IPO gets subscribed multiple times. You'll be shocked to know that out of the 75 companies that have got listed, 20 are already in the negative, and this is after the last 4-5 days of up move. In fact, if you just see the marginal ones who are just above their IPO price, this number will fall to 50%. So almost 50% of the IPOs have now given you zero or negative returns, and some of them have really taken a lot of capital away. And it's not that these are very small companies; these are pretty sizable companies, a lot of them, with IPO size of 2, 3, 4,000 crores also. So again, good buzzword IPO, but at what valuation? And I think that again leads us to the same old thing, that buzzwords, the themes are great, but one has to be very careful when you invest in them. So very short presentation. I think the thought is just to highlight the fact that based on the past, just investing because that theme looks good might work for 1 month, but ultimately from a 2, 3, 4 years perspective, there is significant value destruction which happens. Thank you.